Hi, welcome to TheStreet's free webinar, The Most Overlooked Tax Deductions, What You Need to Know Now. Hey everyone, I'm Tracy Byrnes. The tax deadline is approaching really quickly. Now, there's no need to panic. We're going to get you through this. TheStreet is partnering exclusively with the premier tax expert, TurboTax. And who better to get you through all this than Lisa Greene-Lewis, a CPA with TurboTax for more than 15 years. She has been my partner in crime during tax season for probably just as long. Lisa, thank you for being here and being our voice of reason and calm through this entire tax season. How's it going?
Good, great. Thank you for having me.
We so appreciate you picking your head up from air to come talk to us because I'm sure you are jammed this time of year.
Yes, there's not that much time left, so
I know, we're getting there. Lisa last joined us in February, if you remember, to help us navigate tax reform and what that actually meant for this year's tax return. And of course, you know you can find that free webinar on TheStreet.com. But let's get down to business, man. You don't have a lot of time. We got to put things quickly into perspective. Okay, bunch of changes in the way tax deductions are structured. This is probably going to be the biggest thing that most people see when they sit down with their tax return. And I'm sure, Lisa, you can attest to this, right? So TurboTax estimates that about 90% of taxpayers will now claim the standard instead of itemizing. Last year, about 70% of taxpayers claimed the standard and only 30% itemized. Now, since more taxpayers are going to claim the standard, there are still things that they can do and there are deductions they can take. But Lisa, let's first talk about the fact that more people are going to be taking this standard, and this is all because of the new tax changes, right?
yes, exactly. I think before the stat that you had from previous years, it was people forgetting tax deductions, but now because the standard deduction almost doubled for taxpayers, so $12,000 if you're single, 24,000 married filing jointly. Um, people that did itemize, they may fall into the standard because their itemized deductions may not be larger than that increased standard deduction. And then with the elimination and reduction of some itemized deductions, they may fall into that.
So, but we should also let people, remind people that just because it's bigger, you still really do have to go through the motions, right? You never know. Your itemized may actually be bigger than 24,000. You just don't know. So go through the exercise.
Exactly. You should go through it, and even if you're on the edge, maybe so if you're single and you're at $11,000, maybe you may have donated to charity last year, and a lot of people forget about those deductions because they clean out their closets throughout the year. Think about those things that could push you over the edge of claiming the standard deduction.
For sure. And and you make a great point, which we're going to get to in a bit, because there are a bunch of deductions and credits that you still can take and you don't want to miss. So let's start talking about those now. All right. I know it's really hard to believe that you only have a couple days left here, but there are some things you can still do. And the biggest, and one of the things I think a lot of people forget is this IRA contribution, because I think a lot of people think, Lisa, that December 31st, that's certainly the last time you can contribute to a 401k, but you really do have more time with an IRA, don't you?
Yeah. It's a really smart move because you're building your retirement, but you have up until the tax deadline to contribute to your IRA and make an impact on your 2018 taxes. It's one of the only thing you could do after 2018 that reduces the taxes you owe. You just have to make sure you tell your plan administrator that your contribution is for your 2018 contribution, so they don't think it's for 2019.
Right, that's really important. So if you happen to walk in or send in a check, make sure you denote that it is for 2018. And you have all the way through your extension if indeed you decide to extend your return, right?
Yes, you do.
Okay, so we have an example here, and actually it opens your eyes and you realize how much you could save if you indeed make an IRA deduction. So, up on the screen, 35% tax bracket, $5,500 deductible contribution. That's a $1,900 tax saving. That's huge.
Tax savings, exactly.
That's huge. That could be used in 100 different ways. I've spent the money already, quite frankly. All right, so to move on, and so get that out of the way for sure. If you could do that, please do it. But before we all get too excited about this, again, more reality checks. Part of it is deadline. As a reminder, April 15th. Now, I think in the past, last year, if I'm not mistaken, it was the 17th, right? So everyone needs to be reminded, it is Monday, April 15th, right?
Right. This year it is the 15th.
Yeah, every now and then we have these funky holidays that fall around the 15th in Washington, D.C., and it confuses everybody. The good news is it's a Monday, you have the weekend. So and while you shouldn't wait till the weekend, at least you have it. All right,
Yes.
so.
You could do it this weekend, and then you'll have next weekend, the following weekend free.
That's for sure. And as spring starts to show up, although in the Northeast we don't actually know where it is bone-chillingly cold out there still, then you can get out and at least enjoy the weather. Okay, so more things that people should take into account, last-minute tips. We're going to talk about that. We have a bunch of them, actually. So if we put them up, the first one seems really obvious, but get your documents in order. If you haven't filed yet, it is really important to get organized. Tell people how to do this, Lisa.
Yeah, the first thing you want to do when you sit down to do your taxes, you want to make sure you have the documents that report your income, like your W-2s, your 1099s, have those all in order, and then receipts for things that are deductible, like if you paid for childcare, you want to have the receipts for what you paid for that. Or let's say you paid student loans, your student loan interest is deductible. So you want to have those in order so you don't miss anything.
I always got tripped up at the end with like daycare and summer camp. You need those tax identification numbers, right? So you have to reach out to all the organizations or go online, whatever, and find those quickly too.
Yes, you do need those.
All right, so to me, it blows my head off that people still don't file online, but apparently they don't. But according to the IRS, last tax season, we did see an increase in self-prepared e-filed returns. I would bet that that's going to increase this year. What should we know if we're going to take this route?
What you should know, so e-filing with direct deposit, first of all, that's the fastest way to get your tax refund. The IRS, they are issuing about 9 out of 10 tax refunds within 21 days if you e-file with direct deposit. So it's the fastest way, and also it's a safe way. Instead of putting your documents that have your social security number in the mail. And then also, you will know when the IRS receives and accepts your return. If you put it in the mail, you don't know when they received it.
It's a great point. You know what's so funny is like back in the day, it used to be everyone was so afraid to put their checking information online. It's actually probably safer now to do that than to send all your documents in the mail, and who knows who can pick them up along the way. And by the way, if you wait for the IRS to send you a check, that could take like 6 to 8 weeks. That's crazy. That's just all the more.
Even know when they've accepted it.
Exactly. Plus, you don't even know when they accept it, right? Which for some people, that's like waiting on pins and needles. All right, one of the biggest mistakes taxpayers make when rushing to meet this looming deadline, though, is gathering the wrong information. And oftentimes, people, as we talked earlier, they don't have the correct numbers for childcare and daycare. They forget, or get wrong kids' social security numbers. What advice do you have for people about all this stuff?
Yeah, you want to get those right. The social security numbers for your kids or someone else that you support, because those are worth valuable deductions and credits. Your kids, you can get the child tax credit, the earned income tax credit if you qualify, or like we talked about, the child and dependent care credit, but you need the right social security number in order to get those credits.
Right, so you're basically leaving money on the table because you inputted a number improperly. Like, how crazy does that sound? But you said actually there's some documents that you do not have to wait for. You can get your return out anyway. What are they?
So the documents that report the health care that you pay for. Mm-hmm. So the 1095B and C, those are just reporting documents, and they show that your employer provided you insurance and that you had insurance all year long or however long you have it. So you don't need to wait for those.
What about corrected forms and stuff? Oftentimes, people don't realize that they're getting corrected 1099s. Should people wait on those, or should they be checking their bank? Maybe you should check your bank online just to see if they issued corrected 1099s.
Yeah, you could check with your bank or the provider.
Yeah.
You know, in the event that you did file and then it so happens that you had a corrected form, then you would just file an amended return.
Which is a total pain in the neck. So, maybe before you file, just go check your bank and
Yeah.
broker and all that. Make sure they didn't issue corrected. Because I feel like they often do, somehow. Every year we hear somebody's issuing a corrected 1099. Okay. That being said, though, if you still need help and some hand-holding, you could do one-way video via TurboTax. Lisa's going to tell us more, but Lisa, I have to tell you, and I think I said this last time, I love the commercials. They crack me up that there's like that kid who thinks that he's pretending he's like some really rich dude on a yacht, and then he realizes that TurboTax can't actually see him.
Exactly, and that's exactly how it is. You know, when you connect with our TurboTax Live CPAs and enrolled agents, you can see them, but they can't see you. They can see your screen, you know, where you want them to see it. So it makes it better than a chat. Like a chat, a customer or taxpayer doesn't really know how to explain what they want to ask. With this method, they can see exactly what the taxpayer is asking. And you could be in your pajamas, you could be drinking a glass of wine, they can't see you.
If only that were real, if that was my full day. That would be fantastic. No one could see me, they could just hear me. All right, so now we got to talk about like these infamous 10 overlooked money-saving tax deductions and credits. People should keep these in mind. They're always out there every year, and I feel like every year people forget them, so we have to talk about them. The big one is state sales tax, and I feel like this one in particular is confusing people because we had the changes in the tax law with the real estate taxes, the SALT taxes, people confusing those with the state taxes, state sales taxes, I should say. See, look, I'm confusing it. So maybe you can explain that to everyone.
Yes, I'll break that down. So prior to the new tax law, you were able to choose between deducting your state income tax or your sales tax.
Right.
This was an advantage for states that don't pay state income tax, like Florida or Texas. So you would have a choice to deduct your sales tax that you paid on large purchases, like if you were lucky enough to purchase a boat or something like that. So prior to the new law, you could take the state income tax deduction or sales tax. You pick either or, plus your real estate taxes.
Right.
And you would be able to deduct that whole amount. Now it's capped at $10,000 for your property taxes and your state income tax or sales tax. So whichever one you choose. And one thing, TurboTax walks you through that, and it chooses the one that gives you the best option, or the highest deduction.
Which is why, all the more why I sometimes think that it's a no-brainer to use products like this, because it gets very convoluted, I think, when you start to have to do it yourself and think it through, and just sitting in your pajamas with a glass of wine and inputting numbers and letting this thing do it for you and figure out the most beneficial way, to me, makes so much sense sometimes. But that's what it is. You either choose state tax or sales tax, add it to your real estate, cap it at 10 grand.
Exactly.
Okay. All right.
New law, it was, you deducted.
Right, all of it. Those of us in the tri-state area in California remember, it was a much bigger number, bigger. Reinvested dividends, everyone forgets about these. What should you do with them?
Yes, so you don't forget your reinvested dividends. They could be added to your cost basis. So when you sell your stock, you will have a lower gain. So definitely don't forget about those. Right,
so you add them back to the original price you paid to buy the stock. That way it decreases, you subtract it from the original price, so it decreases the amount of money you pay capital gains on.
Yes.
Awesome, don't forget that stuff. Everyone remembers their big charities, their charitable giving. They have receipts, they get them from the institutions usually and the philanthropic organizations, but oftentimes people forget the little stuff. What are some of the little charitable things that people should remember?
If you drove to volunteer for a charity, your mileage is deductible at 14 cents per mile. even supplies that you bought for a charity, don't forget those. And actually, TurboTax, we have TurboTax, it's deductible. It helps you accurately value and track your deductions and also your miles for your charity work.
Right, so if you bring munchkins to an event, you can deduct the munchkins, right? Or if you actually make the brownies as opposed to buy them, all the ingredients that go into the brownies can be deductible as long as they're all donated to a charitable event.
Yes,
Right.
yes.
So, and save your receipts, right? Do people need to save their receipts on something as small as a box of munchkins?
You should always save your receipts, but the IRS requires if you $250 or more, you should have an acknowledgement.
Right, but I'm with you. I save everything.
Oh, and one thing I do, because I clean out closets throughout the year, and I take pictures of like clothes that I donate or like the bags of household goods or whatever I donate. I take pictures.
That's super smart to legitimize your deduction.
Mm-hmm.
Oh, I'm doing that from now on because we do that too. I make my kids fill a bag like once a month because inevitably there's too much stuff, and we donate it. But I often wing it, so that's a really good tip that people should do that. So you have validity to what you donated.
Yes.
All right. You and I were talking about college before we started. Student loans, top of mind, all over the place these days. What do people need to know about them?
What they need to know is that they are able to deduct interest up to $2,500 that they paid on student loans. And it used to be where it was just specific to the student. They were able to deduct that, but now, parents, if you're claiming your student as a dependent, you can deduct that interest on your return.
Especially if you're paying the loan for little Johnny, right? You're paying the loan. The kid is still your dependent. You should definitely take the deduction.
Yes.
Right. And I think people miss that for sure. Speaking of little Johnny, he got a job. Hallelujah, praise the Lord. Moving the heck out. But can he deduct, he or she, I say, deduct their moving expenses?
No, under the new law, before you could deduct your moving expenses if you were moving for a new job and there were mileage requirements, you can no longer deduct moving expenses unless you're active duty military.
I would think that parents would actually pay their children to move. Well, that's just me, maybe. Pay them to get off the darn couch and get out and get a job, right? So, active military, you still get the deduction. Everyone else, ask your employer. We talked about this in the last webinar, which people should go back and watch. Ask your employer to help pay for the costs if you have to move far, because everything's expensive. It even costs money to move the dog. Ask for help. Mm-hmm. There's a new child tax credit, actually, which apparently people will love as much as their little ones. What's new with that?
So the original child tax credit for your kids, if they're under 17, that increased to $2,000. But there's also a new credit. It's a credit for non-child dependents. So if your child is over 17 and you can't qualify for the child tax credit, you can get this $500 credit for them. Also, if you support a relative, before the new law, you were able to get a dependent exemption of $4,050, but that did go away. So now they have the credit for non-child dependents, which is $500.
All right, so if you have like an 18-year-old who just eats you out of house and home and plays Fortnite, at least you get $500 back on him now.
Yes.
Not speaking from experience or anything. Now, but why would you not qualify for the child tax credit? It's because he or she aged out, right?
Right. The child tax credit is for kids under 17. So, yeah, under 17, you can't get it.
So 17 and above, if you're still basically supplying everything for them, you can take this $500 deduction.
Yes, even, your relatives or even friend that's been crashing on your couch all year, but if you supported them, it's non-dependent credit. I mean, non-child to credit.
And it's credit. I said deduction. I spoke improperly. It is a credit, which is way better than a deduction any day of the week, even if it is only $500.
Yeah.
Okay, so homeowners. Everyone's up in arms about the whole limitation on new mortgages and stuff, which again, we talked about in the last webinar, but we didn't talk about what happens if you have to pay points on your mortgage. So maybe you can talk a little bit about what people should do with them, because I think they often forget to include those on their tax return as well.
Yes, people do forget this. So if you paid points or loan origination fees, you're able to deduct that. So when you purchase a new home, you can deduct the full amount of the points. But there's also people that refinance. So if you refinance your loan and you paid the points or loan origination fees, you would divide that up over the years on the loan. So you wouldn't get to deduct the full amount up front, but you know, let's say your loan origination fees were, I don't know, just a low amount I'm going to give.
Yeah, well, we have an example up on a 30-year mortgage. If it's 30 years, you would deduct basically 1/30th of the points every year. So to your point, let's just, I don't know, presume it's $5,000. You deduct 1/30th of the $5,000, or our example is $1,000. I'm sorry. So that's $33 on the $1,000. If indeed those are the points you paid, that's $33 a year you get to deduct. I mean, it sounds small, but take the deduction. Why not?
Right.
Right.
Exactly. And also don't forget, you know, a lot of people refinance more than once. And
Right.
if you have those points left that you have not deducted on the old loan, when you do a new loan, you could deduct the full amount of those points because that loan is closing. So don't forget about that either.
Right. That's actually huge. And then you start to take the next loan over the course of the lifetime of the new mortgage, right? Yeah. Right, but wipe the other one out. Take the whole amount in the year you close out that loan and refinance. All right, on the day that Lyft goes IPO, we have to talk about self-employed people. And there's some big items. And I love actually that we've created this gig economy where so many people are working on their own and completely self-employed. What are some things that self-employed people forget this time of year?
So self-employed people, a lot of them, one of the big ones, they're hesitant to take the home office deduction. Mm-hmm. And if they're using their home office for their business, they are eligible for that deduction and they should absolutely take it. You know, they get a portion of their home expenses, like their rent, their mortgage interest, their property taxes, utilities, based on the amount of space they use for their business. So they can take that, or they can use the simplified method, which is up to $1,500. And it is based on a maximum square footage of 300 square feet at $5 per square feet.
Right. It's, if you use it, you use it. I mean, I would stand up and take it for sure. And I also think, and I'm sure you'll agree, that walking through the Schedule C, which is now the form that a self-employed person has to file, it jogs your memory a little bit of all the stuff you purchased all year long, right? Because there's all these line items for marketing and office expenses and things like that, and you start to realize, oh my God, I bought staplers and I bought a printer and I bought all this stuff. And so I think that's really, it's a really good exercise for self-employed people.
Self-employed can take so many things as long as it's directly related to your business. Mileage is a huge one, and we're talking about the Lyft drivers. You know, you want to track your mileage. I know we have QuickBooks Self-Employed that integrates with our TurboTax Self-Employed, and our QuickBooks users find that they can deduct about $7,000 in mileage. That's huge.
That's huge.
That's the average that our QuickBooks users have found.
Wow. I gotta start figuring out how I could charge my kids, because I probably it probably cost me that much money to cart my kids around all day long. Too bad I can't deduct that.
Exactly.
People should keep track, though. That is a huge number, and that makes a big difference. Okay, the Earned Income Tax Credit, I think, is one of the most misunderstood credits on the entire tax return. And because of that, only about 20% of those that are eligible for it actually take it. So Lisa, we have to explain what this is, because for low-income people in particular, it's a huge credit.
It is a huge credit. So it is a credit for it originally came about to give people incentives to work. So you have to be working. It's for low to mid income workers, and you get this credit. It's based on your income, and then it could be how many kids you have, but you can also get it if you don't have kids. But a family with 3 kids can get a credit of up to $6,431. So that's huge. And a lot of people miss it because maybe their situation has changed. Maybe they do think that they make too much money, but if you've had changes in your income, you know, maybe been unemployed for a few months, you may qualify for it.
Right, you took a pay cut, maybe you went on a part-time schedule. Like, there's a lot of reasons your situation can change and you can qualify. So this is another one that I don't think you should avoid when you get to the part where you're inputting your information for your tax return. Don't skip this. Go through the exercise of inputting the numbers and letting a service like TurboTax calculate it for you, because you might be really pleasantly surprised. $6,400, by the way, huge credit.
Huge. And TurboTax won't let you forget about this, because it has your income information that you put in from your W-2s, or you know, if you're self-employed. So if you fall into those thresholds of income, it'll remind you like, hey, it looks like you may qualify for earned income tax credit. So it will remind you.
All the more people should really walk through this. All right. If you happen to be lucky enough to have retired, and it's not like I don't want to work, but I do have visions of being retired on a beach with a bottle of wine and the sun always shining, by the way. What do retirees need to know? I know with all these changes in the tax laws, there's definitely things that they need to think about as well.
Yeah, they need to think about, I know we're seeing a lot of retirees, as we're talking about Lyft and Uber again, we're seeing a lot of retirees that are doing side jobs. And so they really need to think about how that impacts, like if they're getting Social Security income, they need to think about how other income could make Social Security income taxable, because typically if you just have Social Security income, that will not be taxable, but other forms of income that you get can make a portion of it taxable. So if you're getting, you know, withdrawing from your retirement now, or doing the side job, that could make that income taxable.
It is a great point, right? And then people really should determine, maybe they should put off starting to take Social Security. If they can supplement, maybe they don't need it yet. Maybe, you know, between required minimum distributions from your IRA or whatever, or your 401k, and taking a couple rides during the week on Uber or Lyft, it might be enough. So it might be worth at least doing the calculation.
Right. And then I also see retired people, a lot of them have paid down their mortgage. So they don't have a big write-off for mortgage interest. And especially now that they may move into the standard deduction with the increases in the standard deduction. When that happens, they should remember that they could do a contribution of a qualified charitable distribution directly to a charity, and then they would be able to deduct that, and it's up to $100,000.
That is a win-win, I think, that so many people forget about, right? So you have to take your required minimum distribution after 70 and a half, and if you don't want the money and you don't want to pay the tax on it, but you are charitably inclined, you just send it directly to the organization and you get the deduction to boot.
If you could afford it, yeah,
right.
Definitely. And then especially if you don't have those big itemized deductions anymore.
Right. I think it's such a win-win. And just to remind people, because we've been talking about this standard deduction so much, it's $12,000 for singles, $24,000 for married. But charity is separate from it all. So you still get these charitable deductions. It's really something to think about if you are in a position to not need that IRA distribution and have a charity that's near and dear to your heart. I think it's a win-win.
Yes.
right? It's one of the really cool things, I think, in the tax code.
Yes.
Okay, we got to talk about going on extension, because there's a lot of people that are thinking, oh my God, we're coming up on April, I'm toast, I'm going to extend. What do you think?
The first thing I would say, if you can file by the deadline, just file. A lot of people are under the misconception, like if they owe money, they'll just file an extension, but an extension to file, I mean, an extension is only an extension to file. It's not an extension to pay what you owe. So if you owe money, you want to try to pay what you can. And then also you definitely want to file on time. If you absolutely can, if you're missing something and you need to, extend, definitely file that paperwork for an extension. Because you don't want to get a penalty
Right.
for not filing.
Which we'll go through the penalties, but we should reiterate your point. You have to file something by midnight, April 15th. I always say, Uncle Sam is much like a spoiled teenager. Like, they want what they want when they want it, and they're not going to stop annoying you till they get it. So send him something by April 15th midnight, whether it's your return or whether it's an extension. At least get that in the mail or stamped, e-filed, whatever.
You talked about you could be getting a refund by the
Right.
time you go through, like,
Imagine.
some of the deductions we talked about. So you want to just file so you can get your tax refund.
Super pleasant surprise that would be, right? All right, so but it is a 6-month extension. If you do go an extension, so you have all the way to October 15th, but to your point, it does not mean you're off the hook. So in theory, you owe your bill. If not, you get hit with all these penalties and interest. So let's just walk through some of these, the penalties. And the biggest penalty is not filing on time.
Yes, it's 0.5%, and it can go up to 25% of what you owe.
Which is crazy. So just file
I said 0.5%. I mean,
Yes.
it is 5%.
It's 5% up to 25%. And it's just because you didn't file a piece of paper or you didn't hit send on your e-file extension. Like, it's really silly. And we have an example here. $2,000 is your penalty per month times 0.5%. Total possible late payment could be 25%. That's $500 just because you didn't send something, which to me is craziness. This next one is pretty crazy too, though. Your underpayment penalties, the IRS starts calculating interest and it adds up really quickly, doesn't it?
Yeah, well, so the late payment penalty is 0.5%. And then you also do get charged interest as well.
Right, and interest is calculated at the Fed's short-term interest rate, which is about 0.81% now, plus the IRS is 3%. So tack that on to 3.81% on all the money you owe, that adds up really fast too.
Yeah, it can. So, I mean, definitely if you owe, like I said, pay what you can. And then also the IRS, they will do installment agreements that allow you to pay over 6 years, but you still will accrue like the interest and late payment penalty.
Right, but to me, that's really important too. You just acknowledge that you don't have the money right now. And I think the IRS, for the most part, is like pretty cool with it. You can get on their payment plan. You can almost tell them what you want. You're able to send. For the most part, they'll be cool with it as long as you just admit the problem. Don't hide from it. I think that's the biggest thing, right? So many people are afraid of the IRS and they don't say anything.
Yeah.
I know. Okay, we went through so much stuff, Lisa. Oh, real quickly, have you seen or do oftentimes extensions get rejected?
I have not seen that yet. And I know you can submit them for federal, and some states don't require you to submit an extension if you did it on your for your federal taxes. But it depends on the state though.
Right, so check your state because you may have to file 2 extensions or how many states you earned income in. A federal and then your states, but everyone needs to be notified that you're going on extension. So don't forget anyone.
Yes. And with TurboTax, in the event you really have to, we have easy extension that goes. Perfect. Your extension it goes right to the IRS. It's all online. But I would suggest, start this weekend and get your taxes done.
Yes, get them done before, at least if you're in our area, before like the sun starts to come out, because it's been horrible and cold around here, Lisa. You're very lucky that you're in the sunshine state, I have to tell you, even though your taxes.
I know, and you've been complaining because it rained months on end, but I know we can't really complain.
No, even though we are all simpatico when it comes to our state taxes and the laws of our SALT deductions. All right, so we covered so much stuff. What are we missing?
I'm trying to think. I mean, there may be some different deductions you're not thinking about. Like if you were married and donated your wedding dress or decorations, something like that, you may be able to deduct that. So I'm just trying to think of some different deductions.
Right.
If you loaned a friend some money and you were unable to collect on that money, that's a personal bad debt, and you could deduct up to $3,000 for that.
And
So don't forget that.
a bad friend. Right, gambling, we're in the middle of March Madness now. It makes me think of gambling, gains and losses. Those all have to be reported.
Yes, your gains have to be reported, and if you itemize your deductions, you can claim your losses up to the amount of the gain. It can't be over the amount of the income that you earned.
If you take the standard, you can't take the losses then. Well, in theory, you can't take the losses, right? So there's a ton of stuff. So everyone needs to certainly check out TurboTax. Their live CPAs and enrolled agents actually are super helpful and useful. There's a ton of tools, ton of things on the site. And not to mention, actually, before we go, tell everyone how they could file for free.
Yes, so there are millions of taxpayers out there that qualify to file for free with our TurboTax Free Edition. So if you have W-2s, if you can claim the standard deduction, which we said about 90% of taxpayers will claim the standard deduction for 2018. And if you can claim some credits for your kids, like the earned income tax credit that we talked about, or the child tax credit, you can file your federal and state taxes for free.
It's really cool. Not to mention there's the app for those, people with super, super simple returns. You could do it on your phone, like while you're walking to the train, quite frankly. Just get it done before the 15th. Lisa, we can't thank you enough for taking the time because we know how busy you are this time of year. Everyone needs to check out TurboTax.com for more tax advice. Lisa Greene-Lewis, she is the best. This free webinar will be available on the site. Lisa, we're going to do this again and again and again because all you've been doing is helping people. Thank you so much.
Thank you.
And of course, you'll find a replay of this webinar on TheStreet.com. I'm Tracy Byrnes. Go get your tax return done. Thanks for watching.
Thank you.